Tuesday the 8th, European stocks fading earlier strength. Energy, the real reason. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So 30 minutes to go. Let's talk about the price action here in Europe. European equities fading an earlier positive move. We are now negative on the stock 600. It's more mixed when it comes to the individual bourses because energy is a huge factor in the mix today in terms of the downside move that we're seeing. The bond market also front and center. So these are the kind of two really important asset classes that I'm watching certainly here in Europe. We continue to see yields marching higher, particularly on the periphery. The Italian 10-year now yielding 1.866. Still below where we are in the United States. But the big story, I think, from an equity point of view, is this rollover we're seeing in Brent prices. Now, energy prices have gone up very sharply. We're seeing maybe a little bit of consolidation, but we're down by 2.5%, and that's enough to drag some of the energy names a little bit lower. We've also had BP reporting. We'll talk about that, Kaylee, a little bit later.
Well, Guy, it's a similar story here in the U.S. Energy far and away your laggard on a sector basis in the S&P 500. It's down hard. The S&P 500 as a whole, though, is actually in positive territory, up about 0.3%. And there is an outsized mover I have to point to, Peloton. Of course, it reported early. It was supposed to report after the bell today. It then reported this morning after a scoop from Dow Jones that its CEO, John Foley, is stepping down. Peloton indeed confirming that is happening. They're also going to put into place some cost cuts. All of it maybe potentially raises the odds of a potential sale of that company. As a result, that stock is up another 20% after a 20% move yesterday. But it really all comes down to the bond market, Guy. We are seeing very, very close to 2% yields for the first time going all the way back to 2019. Right now, that 10-year yield is up almost 5 basis points. 196.32 is where we sit, getting very, very close to that round number, Guy.
Well, let's talk about it a little bit more, Kaylee. Does 2% actually really mean anything? Does how fast we get there mean anything? Caroline Simmons, UK CIO for UBS Global Wealth Management, joining us now to give us her take on this. Let's broaden it out. Let's just not focus on what is happening in the United States. We are continuing to see really quite big bond yield jumps, not only in the States, but in Italy, in France, in Germany, and the United Kingdom as well. How should investors be thinking about these? What advice are you giving about these moves? Everything is happening very quickly, Caroline. What do investors do with that?
Yeah, so exactly. I think what's happening is the market's obviously trying to price the expectations around not only the rate rises, which we've seen increasingly more hawkish pivots from greater numbers of central banks, but also quantitative tightening as and when asset purchases stop and or run off and or get unwound, depending on the region. I think the level of the bond yield itself at these sorts of levels isn't that material. It's more about the speed of the change. But obviously, the higher the bond yields go, the more derating you get of equities, of long duration equities. And so you do get an impact on the equity markets from the bond yields in terms of rotation. So we think that it's worth sticking with value trades as long as we see further upside to the bond yields, which we do from here. So it would be preferences for energy sectors, financial sectors, those types of parts of the market that tend to do well when rates or yields are rising.
Well, let's talk about that value trade regionally as well, because Goldman Sachs put out some research this morning saying that hawkish pivot from the ECB actually is a good thing for European equities because it indicates that some of the problems that have plagued Europe for so long, lower nominal growth, disinflation, no earnings, that's starting to turn around. That's what is evidenced by the hawkish pivot from Christine Lagarde and co. Do you agree with that? Do you like Europe here?
Yeah, we do. We've got Eurozone equities as a sort of most preferred region. We think there's some good close to double-digit upside. The sort of region is cheap versus global equities versus its historical discount. It's a cyclical market. It's got looser monetary policy, despite the fact that will also be tightening at some stage, and it's got strong earnings growth. So very much a preferred region for us.
What about the UK? I'm just looking down the numbers year to date. Euro Stoxx 50 down by 4%, FTSE 100 up by 2%, CAC 40 down by 1.8%, DAX down by 4.2%. Does that outperformance continue?
It might continue a little bit as long as the value trade is running, because obviously the UK has got higher exposure to energy and to financials. It's not going to probably last forever, though. It's just as long as these bond yields are moving. And if we look at where the UK yields have got to, they've already moved quite a lot. People's expectations for the Bank of England raising rates obviously started before even the Fed and way before the ECB's our expectations of the ECB raising. So I'd say the trade is probably a little bit more progressed in the UK than perhaps in some of the other regions.
Well, and obviously we're talking about bond yields here, the influence of macro policy. On a micro level, I noticed one of your colleagues at UBS Global Wealth Management, Mark Hayfley, was putting out some research this morning talking about how earnings are showing that fundamentals actually are quite strong. How much does that matter in this kind of environment?
Yeah, so it does matter. But obviously, if you're going to get a big move in the bond yields, then it will cause a derating of the long duration assets. And that obviously initially will outweigh. But what we've seen is that, the moves in deratings happen very quickly. And then earnings tend to take sequential quarters to really get the strong performance of it. So, if companies are beating on the day, which on average they are, by about 5% in the US, by about 9% in Eurozone at the moment, then, you could get some positive share price reaction. But really, it's the sequential quarters of strong growth that will allow the equities to move higher over the course of the year, following the obviously drag down that they've had in the last sort of month from the rate rises.
In order for those earnings to continue, Caroline, we need the economy to continue to remain strong. Clearly, central banks are stepping in to reduce some of the demand that we're currently seeing. And I'm wondering at what point we start to worry about growth. And I'm wondering at what point we start to see that growth concern feeding back into concern around earnings. How far away are you, do you think, from investors getting kind of really nervous about growth and potentially starting to price in some sort of growth shock?
Yeah, I think we're still a bit away from that. We are running well above trend in most regions on the GDP growth. First half will definitely be stronger than the second half, but on average for the year, we're still going to be way above long run averages. I think for the global GDP, we've got about 4.6% forecast for this year, trend somewhere around 3.5. So, we've still got a lot of capacity there. As we get into next year, then we'll continue with the normalization. So growth rates will come down again, inflation will come down again, and rates will go up again. And so then we'll be getting closer to more normal. But for the moment, we are still in actually incredibly high growth rates. And the fact that the central banks are raising rates is to reflect the fact that the economy is so strong.
So does cash have any role to play in a portfolio here, Caroline, given the environment that you're describing?
So, we have a preference for equities. So we think equities will be outperforming. Cash, some clients obviously need a level of liquidity for their day-to-day spending. But other than that, we think that the best returns will be achieved, from the equity market rather than from the fixed income or from cash.
In terms, though, of managing this process, what are you hearing from clients? I'm sure that's the advice that you give them, that they want to stay invested. They should stay invested. What are they saying to you about what they see in front of them? These equity markets have had a phenomenal run, driven by huge amounts of liquidity coming out of central banks. The largesse from central banks has been amazing. We now have most major central banks, bar the BOJ, stepping away from that. Are they telling you that that is something that makes them nervous? Are they worried that we are going into this tightening cycle with equities incredibly elevated vis-a-vis where we would normally be historically?
I think the majority are not actually that worried. Obviously, some people are. But when we talk them through the fundamentals, and yes, equities have performed very strongly, but actually you can match that to the earnings growth that we've seen. And equities didn't dislocate from fundamentals. Equities went up because earnings went up. And that's a very logical thing to have happened. At the beginning of the year, when we had the sell-off, obviously, we were talking to our clients even more frequently than normal to explain what we thought was going on and what our views were. And we did actually see quite a few clients who had been perhaps waiting for an entry point, putting some of their liquidity into the market. So there's always a bit of a variety of what's going on, depending on people's personal risk tolerances. But most people, understand that they're investing for a slightly longer time horizon. And, we have between 5 and 15% upside on equity markets this year, depending on the particular region. So that's pretty enticing.
All right, Caroline Simmons, UK CIO at UBS Global Wealth Management. Thank you so much for joining us and giving us some insight into your thinking as we see this narrative moving more towards hawkishness of central banks. And Guy, I just have to give a shout out to Michael Purvis over at Tallback and Capital. His latest note coming through my inbox, the subject line is the changing of Lagarde. And I have to be honest, I'm a little bummed I didn't think of that first because that is an incredible TV headline.
Absolutely. We can steal it. We can take that. We can use that. I appreciate that we're going to have to name check Michael in this, but nevertheless, that is great work. And it's, we're definitely going to steal that. I want to come back as well to the Neil Young thing as well. I think that's worth a little bit more of a shout out as well. Basically saying sell banks and sell financials, which is every single conversation we seem to have at the moment is basically buy financials, buy energy.
Yep.
So,
Neil Young apparently not into the value trade, Guy.
Well, that's kind of where I was going. I think there's got to be some joke along these lines. Neil Young, I need to go back through his musical compilation. There's got to be a song in there or something in there about the value trade. We'll find it.
Yeah, you do that in the commercial break. Headline. We'll come back to it. And coming up also on the other side of this commercial break, we'll be talking about the European Union and its ambitious plan to prevent another global semiconductor shortage. We spoke about it with the EU's competition chief, and we'll have some of that next. This is Bloomberg.
So I'm going through the Neil Young songs, trying to find one that kind of relates to the investment advice that maybe he's giving on oil stocks and financials. Nothing yet that really stands out. Answers on a postcard or on Twitter or on IB. You got anything that really stands out? We should probably move on before everybody shouts at us. The European Union, Kaylee, apparently wants to take care of its own destiny when it comes to semiconductors. The proposed CHIPS Act, I think I've heard that somewhere before, haven't I? Calling for a quadrupling of chip production in the EU. They're looking at a number of around circa 20%. That's by 2030. Now, Bloomberg's Maria Tadeo spoke about this. She talked to the EU's competition commissioner, Margrethe Vestager.
Well, it's huge in that respect that this will increase the European footprint in the global semiconductor value chain, prevent choke points, prevent new shortages, and enable, not just the big ones in Europe, but also the smaller ones in Europe to be part of designing, producing, and migrate into use also cutting-edge chips for their production.
And how important is it to be able to establish your own footprint? I mean, there's always concerns that perhaps in Asia, countries like China, too, who at times are strategic rivals, they have too much of a footprint in Europe. Is this about reclaiming perhaps some of our own industry?
Well, it is, and it's also about prevent future crises, because we can be a much better partner for like-minded, be that the US, South Korea, Singapore, Japan, much better partner if we have not only production capacity, but also invest in the strength of Europe, so our research capacity, all the equipment for producing of chips that you find in Europe. So I think if we can click in better in the European system, well, then we can also better prevent shortages like the ones we have already.
And of course, chips, it may sound like this is something that you just find on your phone, but this is virtually present in everything that we do in life. You also say that comparable in terms of investment, this almost equals the United States. So we're talking about how much money invested in this and for how long a period?
Well, it remains to be seen because, of course, member states play a crucial role here and businesses play a crucial role.
That was Margrethe Vestager, Commissioner for Competition and Executive Vice President of the European Commission, speaking earlier with Bloomberg's very own Maria Tadeo. So let's get more on this EU CHIPS Act. Mandeep Singh of Bloomberg Intelligence is joining us now with more. So Mandeep, she was talking there about the amount being invested. 43 billion euros is a lot of money, but I think we know if you throw money at it, it doesn't necessarily fix the problem quickly, or else we probably wouldn't be where we are right now still. How much and how fast can that make a difference?
Well, so we know they talked about, capacity going up by 2030. So this is really a long-term, 5 to 10 year kind of a plan. And look, when it comes to chip shortages, what we have figured out it's not just the leading nodes, what TSMC is making, it's also the lagging nodes, that automakers need. And Germany has a lot of them, and, Europe in general has a lot of companies that rely on these auto chips. So I think it makes sense. But again, when you're kind of building a fab or thinking about long term, you have to think about talent. You have to think about, sourcing. I mean, the good thing for Europe is they have all the semi-cap companies based in Netherlands and in Europe. So it kind of makes sense that they're trying to do something there in terms of capacity.
Mandeep, if I take the model that we see in Taiwan, there is financial assistance, but it's not just financial assistance in terms of the aid that is coming from government. It's also zoning, it's water, it's land. The list goes on and on in terms of the support that the chip sector has been given in that country. Is that something that the United States and Europe are capable of replicating, given the current kind of regulatory environment around such huge investments?
Well, so clearly, I think there has been a change in attitude, and you see even with the U.S., the Competes Act and what they're trying to do with, opening up fabs here. And look, it's not going to be any new company. It's going to be the existing companies, the likes of Samsung, Intel, even TSMC opening a fab here. So what they're really trying to do is to encourage all these companies to spend CapEx, and then the governments can subsidize their CapEx spending in terms of opening these fabs. But again, nothing is going to make a difference in terms of capacity, at least, for the next 5 years when it comes to these regions.
Well, speaking of these regions, let's talk about one region in particular. The UK is where ARM is housed, obviously a very key chip designer, which has been in the news today. Now, SoftBank's planning to IPO that company potentially next year after that deal with NVIDIA fell through. I'm wondering what you make of that plan, especially considering the reason the NVIDIA deal fell through was because a lot of concern, not just from regulators, but also their customers about what this deal would do.
Yeah, well, look, I think NVIDIA is at a disadvantage here, and it would have been a good deal even for ARM. I think an IPO won't be as easy as you may think, even though it is in the chip sector and ARM is being used by a lot of companies. But at the end of the day, what it would have done to NVIDIA is allowed them to expand into different end markets. And with semiconductors, the broader end market exposure you have, the better off you are. Right now, NVIDIA is really focused on AI. They don't have much exposure on the smartphone and the CPU side. But look, it was a tough deal in terms of, conceptualizing it going through. And what we have seen is there were too many regulatory hurdles, and it's good that they called it off at this point of time.
Mandeep, huge blow to the UK that it's not going to be listing here. We don't know that yet, but the expectation certainly is that it will list in the States, where you have a deeper pool, maybe of knowledgeable investors. NVIDIA was looking at around 40 billion. As a standalone, what do you think ARM could potentially be worth?
Well, so we know they are around a $3 billion revenue run rate. I think the growth has been decelerating, but again, it's proportional to the number of chips that are being sold in a given year. So even if you apply a 10 to 15 times sales multiple, you get to around, $40 to $50 billion valuation. And given the kind of volatility we have seen, I don't think any IPO is going to get that kind of, high multiple that we were getting in the last 2 years.
Mandeep, we'll leave it there. Great stuff as ever. Fascinating analysis. Mandeep Singh of Bloomberg Intelligence on Europe's Chips Act, the US's Chips Act. Yeah, everybody's getting in on the Chips Act action, and also what is happening with ARM. After the gold rush, that's what I'm going to settle on for a Neil Young song in terms of how it relates to the market. Talking of investing in energy, Kaylee, BP posting its highest profit in almost a decade, and it's promising more share buybacks. We spoke to the company's CEO. He is, of course, Bernard Looney. That conversation next. This is Bloomberg.
BP CEO Bernard Looney spoke with Bloomberg TV about their bumper earnings, also a big buyback. He foresees a further tightening of the market and increased volatility because of geopolitical uncertainty. Take a listen.
Actually was a good year for trading in 2021. We have a great organization. I'm very proud of them. As we look to the future, Oil prices, it's always difficult to tell. I think we've learned early in our career that making predictions isn't always the smartest thing to do. But there is a lot of uncertainty, I think, today. We've got what's going to happen with Iran. We've got what's going to happen with the response, the shale response in North America. We've got concerns in Libya. We've got questions about demand. What happens if there's another variant? So a lot of uncertainty. But what I will say is that demand is strong. And you can easily see a further tightening market throughout this year. But more than anything, I think we should expect some volatility. And at the end of the day, we don't know what the price of oil is going to be. And that's why we're running our company to focus on a break even of around $40 so that we're resilient to a range of price outcomes. We don't control it, but we do control how we run our business. That's why we're taking out $2.5 billion of cost. That's why we're doubling down on convenience. Convenience sales up 20% over the last couple of years.
Bernard Looney, the CEO of BP, talking to the team a little bit earlier on. BP and Shell, the two biggest drags on the FTSE 100 by some considerable margin today. Shell's down by 3.2. BP earlier up, Kayleigh, now starting to fade a little bit, down by 2.29%, reacting really to the oil price drop that we're seeing. I really struggle, though, with these companies and how you understand what they are and what they're going to become. BP is looking basically to cut oil and gas production significantly by 2030. It's looking for 50 gigawatts of renewable capacity. It trades at a discount to the oil sector, but it also trades at a discount to the renewable sector. So it's underperformed the oil sector, but trades at a discount to the renewable sector. So it's trying to make this transition. But I think trying to understand as an investor what you're guessing here is really difficult. And I think a lot of people just simply own it because it's giving back a dividend and it's buying back stock.
Do you think Neil Young would own it, Guy? It's trying to make a transition, not so much fossil fuels anymore? We keep coming back to this.
He's all about... he's after the gold rush. And is the gold rush about to end for the oil sector? But Neil Young telling people that they should be getting out of the banks and getting out of the oil stocks, as I say, not the best investment trade so far this year. Like Shell, I don't know what it's done year to date, but these numbers are massive. And you look at the banks, just amazing in terms of some of the performances that we're seeing, Kayleigh. Credit Suisse, maybe a little less. So wrapping up the session here in Europe, let's talk about the day that we've just seen. Started off really strongly. Started to fade as we come through the end of the day, though. The FTSE 100 actually really emblematic of this. What we're seeing certainly is energy coming under quite a lot of pressure. You're seeing Brent coming down, despite the fact that actually the numbers out of BP today were fairly good. The market not rewarding because the bigger macro story is the overarching theme that we're watching. And you're seeing rates going higher in Europe as well. That is an ongoing theme. It's interesting. Christian Saving making some comments about Christine Lagarde's pivot just a few moments ago, the boss of Deutsche, really kind of again talking about this huge shift we're seeing in the narrative here in Europe. Banks and oil, the two big trades that we're watching so carefully. The IBEX up very strongly today. The CAC up by around 0.2%. The DAX up by around 0.2%, but the FTSE down by 0.2%. Remember, the FTSE continues, though, to outperform year to date. This is the trajectory of the session, as I say, early gains fading fairly fast and then into a fairly narrow channel as I think everybody's focusing on those other asset classes. So we're coming through the end of the day, barely changed. 465 is where we are as we come through to the end of the day on the stock 600. But the narrative is elsewhere. It's in BTPs. It's in euro dollar. It's certainly in Brent today. Brent down by 2.6%. We're watching euro dollar just fading a little bit, still with a 114 handle. We're building up to that CPI number out of the United States. We're approaching 2% on a US 10-year. Maybe not important in the kind of the big scheme of things, but nevertheless, a psychological marker of where we've come from. It's interesting that BTPs are still trading under Treasuries, 1.844, but the rise continues. The pickup in yields post that Thursday press conference from Christine Lagarde is certainly still happening. So let's talk about where we are with the sector story today. You'll get an idea of the narrative developing here. We are certainly seeing energy coming unstuck. That sector down by 1.72%. But we are seeing technology down, real estate's down, the luxury sector's down, healthcare under pressure as well on the back of those Pfizer numbers. Where are we seeing the strength? Basic resources, the miners are continuing to have a good time. Take a look at what's happening with Aluminium. We're going to be talking about that in a few minutes' time. Banks continue to rise, up by 1.81%. The insurance sector continues to make gains as well. Telecom in the mix too, which is interesting, up 0.6%, despite the fact that actually we're seeing some weight on Vodafone today. Iliad potentially looking at picking up Vodafone Italy, certainly making an offer for that business. We'll see where we track with that. Vodafone potentially maybe looking to offload its UK business as well. Ocado under significant pressure. Now, BP and Shell are a big drag on the FTSE 100 today, but Ocado in the mix as well on the downside. This is a company that is investing for growth, but the top line is struggling here as we see problems as a result of what is happening with demand. We're also seeing problems in the middle of the P&L as well in terms of the availability of labour and kits, just inventory in terms of making the robots work. All of that is putting pressure on Ocado today. And the market really is concerned about the level of investment versus the kind of the profit generation that we're seeing out of the company. And Ocado down by 14% as a result of that. But the banks continue to perform. We've got those comments coming through from Christine Lagarde. We've got BNP out with numbers as well. We'll talk about Credit Suisse in just a moment. But BNP out with numbers. I think there was some concern around these numbers. So we haven't seen that big a reaction in terms of BNP today. Under a little bit of pressure. But nevertheless, the stock trading 65.97. The macro picture, very solid, Kayleigh.
Absolutely. And we actually got more color on BNP Paribas results. Our Bloomberg's Caroline Conan spoke with the CFO earlier today. Take a listen to that conversation.
You should look basically at CIB and over the entire year. And if you do this, you'll see that BNP Paribas CIB has increased its revenues in 2021 versus an already high base in 2020.
You're raising your dividend to 60% payout ratio. Does that mean you're confident this kind of performance, especially for the equities business, will continue?
Listen, if you look overall, you clearly see that we have a very diversified activity. And when we look at CIB, it's really flow business, yeah? So it's following the client's needs. We're grabbing market share in those domains. So we're steadily growing. And that is basically what we do. And that is why we feel confident to step up the payout ratio.
You're talking about the flow of the business. We're 2 months away from the French presidential elections. Do you see any interest from French clients, international clients? Do they inquire about these elections? And is it having an impact on flows?
Listen, you're talking to the CFO of BNP Paribas. So I do not have a crystal ball to predict the outcomes and the likes. What, however, we do see is that the pickup in the economic texture, and particularly in the sectors that we are serving, has been very solid. This is basically what you see in our results 2021.
What concerns you the most at the European level? Is it the future interest rates spikes, or is it geopolitical tensions at the moment?
But if you look at the uncertainty that hangs a bit over, is indeed the interest rates. Yeah, you see different positions unfolding. But in the end, if you look at BNP Paribas, what is important is that we can accompany the growth in Europe. And that therefore, even if the rates would go up, that is what we will do. And intrinsically, we have taken a very conservative stance when we made our objectives in our plan. So if the rates would go up, showing even a faster growth, then of course, that will be the cherry on the cake.
The ever-optimistic CEO of BNP Paribas, Lars Machenil, talking to Caroline Conan after the numbers were released. It's a big day for European banks. Credit Suisse also in focus, coming off its worst year since the financial crisis. And Swiss regulators are about to make life potentially a little bit tougher in terms of staff retention. Regulators believe that the bank is being a bit too generous when it comes to the bonus pool. Let's bring in Bloomberg's Sonali Basak to talk about this and everything else. Sonali, great to see you on the show. Credit Suisse has already got problems in terms of talent retention. We've seen huge turbulence within the business. Greensill, the scandal. Archegos, the scandal. Changes at the top forced by COVID rules being broken. Now we have regulators coming in and saying, actually, bonuses may need to come down a little bit. How does Credit Suisse hang on to talent at this point?
Yeah, it's been a very difficult year because we have seen a fair bit of attrition last year, including in businesses that Credit Suisse had been doing very well. That includes in the advisory business, where they have long been a top 10 M&A advisor, and also in that prime brokerage business where we've seen people step down in the wake of Archegos, and they were really fighting hard in equities. So then where does the future businesses go when talent is strained and the bonuses are likely to be down 10% because FINMA is concerned? And remember, as you know, Guy, Swiss regulators are among the toughest in the world after previous debacles. They really want to keep those capital buffers really tight at UBS and Credit Suisse. So it does leave a lot of questions for talent. It was a great scoop led by Marianne Halftermeyer that says that, already the bonus structure was causing dissatisfaction among bankers. That includes some of the clawback provisions that were being discussed because they were wondering, why stay if we're going to have to pay back money to begin with. This idea of bonuses in cash is also another big question mark. While that would have been a good thing to retain some talent, there's going to be a limited amount of that cash to go around. And we have heard of many others on Wall Street doing a very similar thing as bonuses rise so quickly.
Well, when we think about talent retention with banks, compensation, obviously a huge part of it. But in the post-pandemic area, part of it also is flexibility with your work schedule, being able to be at home or in the office. And that actually is our big take story today. Taking a look at Goldman, people aren't back 5 days a week sitting on their desks.
It's so interesting because this big take really discusses more than a third of people surveyed say that they want more flexibility with work. And you do have certain banks really discussing it, particularly the big global banks like Standard Chartered, HSBC, thinking of more hybrid approaches. Citigroup has long been talking about it as a talent retention strategy. But even at Goldman Sachs, before this segment, I went back and listened to a conversation I had with David Solomon about that aberration comment that he had. And interestingly, Guy, he went back and said, listen, I said 98% of traders won't be working from home every day. That will be an aberration. But there will be some flexibility for the people who are working hard for us. And even now, if you think about the way that this year has progressed, many bankers, many CEOs did not think that they would be sending staff home in January. Goldman started this year with about 20% occupancy before the pandemic. I've heard it was around 80% or so. So let's see what the new normal will bring for return to office work.
It's interesting, London, certainly just walking around, people are definitely heading back into the office in greater numbers over even the last few days. Trains are filling up. It's amazing. Maybe actually London gets back to work a little bit earlier than New York. Yeah, a lot of people are. I tell you what, I talked to a buddy of mine last night. He works for an asset manager. He was like, we're back in the office 4 days a week. It's great. So I think he and a lot of other people certainly starting to feel that maybe this is the time finally to get back. I think he'd been in.
The offices, Goldman Apollo, now have a fancy tea and kombucha on tap close to the executive suite. So they're doing a lot of things here to get people excited about being back in the office.
You think Guy drinks kombucha, Sonali?
I do.
I think we'll leave it there, Guy.
I don't know where to go with this. I don't, and I'm not sure I'd be attracted back into the office just based on that. But you never know. You never know. Each to their own. Sonali, thank you very much indeed. Sonali Basak, thank you very much indeed. Some really interesting comments from Christian Saving talking about just how important the pivot is for European banks that has been developed by Christine Lagarde. A little bit of a tick higher, Kaylee, during the auction process. Not much. We're still negative on the FTSE 100, but coming back up to the flat line. Basically a flat close for the FTSE. The DAX doing a little bit better, the CAC doing a little bit better, but we started off very strongly and then we faded as the close came towards us. We'll carry on the coverage at the top of the hour on Bloomberg Radio. Lots to digest here in Europe. We'll do that on the cable, as I say, 5 p.m. in London, 12 p.m. in New York. We're on DAB Digital Radio in the London area. You can find us, of course, on all of your Bloomberg devices. The podcast on Spotify and iTunes. Katie.
Well, Guy, of course, one of the stories Europe is digesting, and the rest of the world for that matter, is the situation in Ukraine and some mixed messaging that we're getting out of world leaders. French President Emmanuel Macron told reporters he has received assurances from Vladimir Putin on Ukraine. At the same time, the Kremlin is casting doubt on that. We'll try to get some clarity next. This is Bloomberg.
This is Bloomberg Markets, the European close. I'm Rishika Gupta, and you're looking at a live shot of the principal room. Coming up, tune in to Bloomberg's monthly series, Chief Future Officer. The latest episode featuring Macy's CFO, Adrian Mitchell, is now on Bloomberg.com and YouTube. This is Bloomberg.
Okay. It says in front of me that was the French president, Emmanuel Macron, but we appear to have lost Emmanuel Macron. But nevertheless, he has been in Moscow. He's now moved to Kiev as well. He's been having a meeting with President Zelensky. Now, earlier, Macron told reporters that he had received assurances yesterday with that 6-hour meeting with Vladimir Putin that Moscow will not escalate tensions with Ukraine. The Kremlin spokesman, though, saying that that's not quite so clear. Let's get more on this crisis, where we are in the process of maybe finding a way out of the escalation we've seen thus far. Bloomberg's Anne-Marie Horden joining us from Washington. Anne-Marie, bring it all together. We had Olaf Scholz in Washington yesterday. We've had Emmanuel Macron in Moscow, now in Ukraine as well. In terms of the perception in Washington as to the progress that has been made over the last 24 hours, where are we?
Well, I think what's going to be interesting is also, Guy, the meeting this evening between Emmanuel Macron and Olaf Scholz in Berlin. Macron's been on a little bit of a European tour while Scholz was in Washington. He now is going to return to Berlin, and these two are going to swap notes on what is going on as they try to be the interlocutors between the United States and Russia. I think yesterday in Washington, D.C., it was very firm where the United States stood in terms of harsh sanctions on Russia, even if that would mean a tough road ahead for the Europeans, especially Germany, when it comes to Nord Stream 2. I would say that Olaf Scholz was a little bit more direct, but not as direct as many would want him to be, not being able to utter the words Nord Stream 2. But of course, this is also something that he is dealing with, difficulties on a domestic front. And then when it comes to the assurances President Putin may or may not have given Emmanuel Macron, a French official has said that Putin's commitment on military initiatives was not firm, but rather conditional on where Putin views the evolving situation, Guy.
Yeah, I think we haven't heard the last of what exactly happened within that meeting. I'm not entirely sure we've had the full read yet. Anne-Marie, thank you very much indeed. Bloomberg's Anne-Marie Horden joining us from Washington, D.C. Let's talk about the impact that this is having into the markets. Any conflict involving Russia would be felt immediately within the metals markets. We've just seen aluminum hit its highest price since 2008. Russia, of course, is one of the world's biggest producers of aluminum. We saw what happened when Rusal was sanctioned a few years back. Could we see some repetition of that? And also, you've then got to factor in and fold in the impact of energy prices as well, which obviously is a play directly into aluminium. Let's bring in Chris Eibel. He is the CEO of Tiberius Group. Tiberius is one of the largest aluminium traders now in Europe. Great to see you.
Good to see you.
Let's talk a little bit. I've known you for a long time. You've pivoted in and out of various businesses. You're now firmly in the metals markets and looking at what is happening with aluminium on the physical side. Let's just talk about your assessment of the market that we see in front of us right now. Why is aluminium as high as it is, and what is priced within it? Is it just higher energy prices right now? Is there Russia risk factored into that market as well?
I think a couple of good points. I think first and foremost, at the moment, what we've seen priced in is the energy situation in Europe. The crisis, that energy prices will remain high going forward. We've seen a lot of shutdown of production in Europe. And as a consequence, this is reflected in the price and in the physical premium. What we don't think is fully priced into the market is clearly an escalation of the Ukrainian-Russian situation. And this clearly brings us back to what we've seen in 2018 when OFAC decided to sanction outside of China, world's biggest aluminium producer, Rusal. And suddenly there was no more aluminium available in the European and in the US market. And if you remember the price action back then, on flat price as well as on the premiums of the value-added products and what it meant for the construction industry, for the aerospace industry, for the packaging industry and automotive industry, I don't want to revisit that if escalations really happen.
Well, Chris, to that point, it's Kaylee in New York. Do you think history could repeat itself?
There's a military truth and reality, and then there's a political reality to it. The political reality is being stamped out in the media right now. I think The military situation, and this is what we pay much more attention to, is crystal clear to us. If you look at the numbers and ask yourself the question, how much has Russia spent so far in its engagement in Ukraine since 2014? The answer is $150 billion. The question is, how much has Duma set aside in terms of for the Ukrainian conflict? The number is probably more like 550, 650 billion. If you look at the dimension of military gear and manpower being moved to a border, this has nothing to do with a exercise or maneuver in any kind of form. And the question to us as traders is, what is the cost of pulling out of the situation, just retreating with its troop? And as a consequence, we actually fear that the escalation is real. And as an aluminium trader, every aluminium trader or any company that is dependent on aluminium, you have certain ties to Russia because of the sheer size of the market in itself. And as a consequence, we need to think about prepayments, we need to think about delivery risk, we need to think about what it means for value-added products, we need to understand what it means for the real economy. And this is actually not necessarily positive, any kind of scenario in that context.
Okay, so let's talk about the impact of an invasion and subsequent sanctions. How high can aluminium go? And it's not just aluminium. Talk me through the other metals and what impact we could see there as well.
I think the first point is what happened in 2018, because this is in some form or shape you can take as a prototype. You've had sanctions, no export possible. SWIFT and all was restricted because of OFAC. The thing here was that very quickly OFAC realized, oh damn, we're sanctioning our own aerospace and defense industry. Let's give them a waiver. So OFAC issued waivers. In this situation, we cannot imagine that if there were sanctions on Russia, or even worse case, a cutoff of SWIFT system, that OFAC would issue waivers. And as a consequence, there's just not enough metal around. You look at actually storage capacity, you look at actually LME stocks around the world, and they're on all-time lows. And to some degree, I must concur with Jeff Curry from Goldman, who said we're out of everything. I mean, that's particularly true for aluminium, that's true for nickel, that's true for other grains as well as energy commodities. So we don't have enough spare capacity to supply the market.
And obviously, in the metals market, it's not just Russia that is an issue. There's also the China issue as well, pursuing COVID zero policy, in which COVID outbreaks can seriously impact production. How do you factor the China wild card into this equation?
I mean, that has been one of the biggest wild cards in general, because not necessarily so much for aluminium, but for other metals in itself, or, raw materials and products that needed to be shipped to the European market because of bottlenecks on logistics, bottlenecks in ports. In this case, we had a COVID shutdown today in one of the bigger aluminium plants in Guangzhou in China. And as a consequence, if you look at all the factors that would mean bullish prices in aluminium, nickel, palladium, copper, and other metals, you can't be short in these markets. And that obviously is reflected if you look at volatility, the skew in itself, how it's priced on the call option side versus puts. And I think, that's what people do, position themselves on an escalation eventually.
If energy prices stay this elevated, is there substitute? What happens with aluminium? Will consumers take it at this price for a long period of time if we do see energy prices staying this high?
I mean, let's look at the facts. We've seen, because of high energy prices, shutdown of around 800,000 tons in Europe. That's gone. We actually don't really see that coming back anytime soon. And the most of the energy hedges that were in place by European manufacturing industry, they will roll off eventually. So basically, when you reestablish your hedges for Cal 23 and Cal 24, you'll hedge at higher prices. And logically, the price level in itself will remain higher. So are we coming back to $2,500 in aluminium? I can't really foresee that, to be fairly honest.
Chris, we'll leave it there. Thank you very much indeed. Great to see you as ever. Great to see you back. A reminder, of course, that at the moment, Russia has no plans to invade Ukraine. But as Chris says, certainly everybody is watching the situation very carefully, and we're trying to figure out exactly what could be priced. Chris Seibel, Tiberius Group CEO. Thank you, sir. This is Bloomberg.
That's going to wrap it up for Guy and I think everyone's probably had enough of us talking about Neil Young. Coming up, Carrier Global Chairman and CEO David Gitlin will be joining Balance of Power with David Weston on Bloomberg Television and Radio. That's here in the U.S., but you have a great lineup coming on radio in the UK, Guy.
We're counting down, obviously, to the end of the week now. that means we're going to get Kaylee's take on what is happening in the Super Bowl. We can't do that. We've got to do that by Thursday. What else are we going to do? The cable's next. I'm going to be going to Bloomberg Radio. Looking forward to that. Top of the hour. You'll find us on DAB Digital Radio. From Kaylee and from me, this is Bloomberg.